Guerin should be a billionaire. He had the same information as Warren Buffett. He made the same investments as Warren Buffett. He even partnered with Warren Buffett for decades. But today, Warren is worth $140 billion. And Rick? Rick had to sell his Berkshire Hathaway shares in 1973 for $40 each. Those same shares are worth over $700,000 today. What happened? Rick made one psychological mistake that cost him everything. And in the next couple of minutes, I'm going to show you the 5 thinking errors that separate the investors who build generational wealth from the ones who destroy it in a single crash. If you're ready to think like someone who can't afford to be wrong, hit that like button right now. Because what I'm about to tell you goes against everything you've been taught about investing. Before we get into this, do me a favor. Drop a comment and tell me where you're watching from. I want to know who's here. City, state, country. Just let me know. Here's what really happened to Rick, and pay attention, because this is probably happening to you right now without you realizing it. Rick was brilliant, top of his class, built a successful investment partnership in the 1960s. He understood value investing as well as anyone. Warren and I respected him deeply. We made deals together. We thought the same way. For years, Rick's returns matched ours almost perfectly. But Rick had one fatal flaw. He couldn't wait. When he saw an opportunity, he didn't just buy it with his capital. He borrowed money to buy more. He used leverage. Not crazy leverage, maybe 2 to 1, sometimes 3 to 1. It seemed reasonable. After all, if you know something is undervalued, why not buy more of it? Then came 1973. The market crashed, dropped 48% over 2 years. Rick's leveraged positions got margin calls. The banks demanded their money. And Rick, despite knowing Berkshire was worth far more than $40 per share, had to sell. He had no choice. The leverage forced his hand. Warren and I watched this happen. We held the same Berkshire shares. We saw the same crash. Our portfolios dropped just as much. But we had no debt, no margin calls, no forced selling. So we sat there. We waited. And when Rick was forced to sell at $40, we bought more. That's the difference. Not intelligence, not information, not analysis, psychology. Rick couldn't ignore the market's pressure. We could. And that one difference, that one thinking error, is why Warren and I are billionaires and Rick is not. Now, here's what you need to understand. Most of you are making the same mistake Rick made, maybe not with leverage, but you're making decisions based on the market's emotions instead of business reality. You're checking prices daily. You're feeling stress when stocks drop. You're feeling excitement when they rise. And those emotions are destroying your ability to build wealth. I'm going to show you 5 mental models that prevent this. These aren't investing techniques. These are thinking frameworks, rules that anyone can follow, but most won't because they require something rare. The ability to sit still while everyone else panics. Let's start with the most violated rule. Most people ask the wrong questions. They ask, how do I get rich? Wrong. The right question is, how do I avoid staying poor? They ask, which stocks will go up? Wrong. The right question is, which investments will destroy me if I'm wrong? This sounds obvious. Everyone nods. But almost nobody does it. And the consequences are catastrophic. Here's why. When you ask how to win, you focus on upside. You get excited about potential gains. You see the best case scenario. Your judgment becomes clouded by optimism and greed. You take risks you don't understand, and you get destroyed. When you invert and ask how to avoid ruin, everything changes. You focus on downside. You see the ways you can lose. You identify the catastrophic outcomes. Your judgment becomes clear because fear is clarifying. You build protection, and you survive. Let me tell you about long-term capital management. This was the 1990s. Smartest people on Wall Street, 4 founding partners, 2 of them, Robert Merton and Myron Scholes, won the Nobel Prize in economics. Geniuses built the most sophisticated quantitative models anyone had ever seen. They asked, how can we maximize returns? They found tiny pricing inefficiencies in bond markets, built mathematical models to exploit them. The returns looked incredible, 40% annually. Everyone wanted in. At their peak, they managed $126 billion. The $126 billion was controlled by Nobel Prize winners using cutting-edge mathematics. But they never inverted. They never asked, what if we're wrong? What happens in the worst case? They assumed their models covered all scenarios. They assumed liquidity would always exist. They assumed correlations would stay stable. They used 25 to 1 leverage. For every $1 billion they had, they borrowed $25 billion. Why? Because the gains per trade were small. Leverage made them big. And for a while, it worked beautifully. Then came 1998. Russia defaulted on its debt. Markets panicked. Correlations broke down. Everything moved together in ways the models said were mathematically impossible. Liquidity vanished. They needed to sell positions but couldn't find buyers. The leverage killed them. In 4 months, they lost $4.6 billion. Everything. The Federal Reserve had to organize a bailout to prevent a systemic financial collapse. Nobel Prize winners, the smartest quantitative minds in finance, they lost everything because they never inverted. They asked how to win. They never asked how to lose. Warren and I watched this from Omaha. We weren't surprised. We'd seen it before. Smart people, sophisticated models, leverage, catastrophe. The pattern repeats endlessly. Stop. Let me ask you something right now. How many of your current investments would survive if your assumptions were 50% wrong? Think about that for 10 seconds. Actually think. If you can't answer that question with confidence, you're not investing. You're gambling with your retirement. Here's the arithmetic that nobody wants to face. If you make 50% one year and lose 50% the next, you're not even. You're down 25%. A 50% loss requires a 100% gain just to break even. Losses compound faster than gains. That's mathematics, not opinion. If you focus on gains, you might make 50% 3 years in a row, then lose 90% in year 4. You end up with less than you started. One catastrophic loss destroys years of gains. If you invert and focus on avoiding that 90% loss, you might make only 15% per year, every year, for 20 years. You end up with 16 times your money, boring, consistent, and wealthy. Same time period. Different thinking. One approach ends in ruin. The other ends in wealth. Compare this to Warren's track record. Berkshire Hathaway has only had 2 down years in 6 decades. Not because Warren is always right, because he structured everything to avoid being catastrophically wrong. He asks, what can destroy us? Before he asks, what will make us rich? That's inversion. Start with ruin and work backward to safety. Start with loss and work backward to preservation. Start with stupidity and work backward to wisdom. Most investors won't do this because it's not exciting. You don't get to brag about how you avoided a terrible investment at a cocktail party, but you do get to keep your capital. And keeping capital is how you compound over decades. Invert. Always invert. But to invert effectively, you need to understand what you actually know. Most people think they understand businesses they don't actually understand. They read an article, hear a tip, see a stock chart going up, and they think they know something. They don't, and this ignorance destroys them. I watch this happen constantly. In the dot-com bubble, 1999 to 2000, everyone became an internet expert overnight. Pets.com, Webvan, eToys, Cosmo. People who couldn't explain how these companies would ever make money bought the stocks anyway because prices were going up. They thought they understood technology. They didn't. They understood that stocks were rising. That's not the same thing. Here's the truth. Your circle of competence is much smaller than you think. There are businesses you genuinely understand. How they make money, what threatens them, what drives their economics. And there are businesses you think you understand, but actually don't. The boundary between these two is your circle of competence. And the most important skill in investing is knowing where that boundary is and staying inside it. Warren stayed inside his circle for 60 years. He understood insurance, candy, railroads, utilities, simple businesses with predictable cash flows. He didn't invest in tech for decades because he said, "I don't understand it well enough." People mocked him during the dot-com boom. They said he was old, out of touch, missing the revolution. His returns lagged. Money poured out of Berkshire into tech funds. He looked foolish. CNBC questioned whether he'd lost his touch. Then the bubble burst. Tech stocks lost 80%. Berkshire lost nothing. Warren's circle of competence, his willingness to admit what he didn't know, saved him from catastrophic losses that destroyed a generation of investors. He didn't need to understand technology. He just needed to know that he didn't understand it. The problem is that admitting ignorance feels like weakness. People want to be seen as smart, informed, on top of trends. So they pretend to understand things they don't. They invest outside their circle of competence and call it diversification. And they lose money. Let me tell you about a doctor I knew in Omaha. This was 2005. He was 50 years old. Successful physician, made $400,000 a year. Smart man. Brilliant at medicine. He did not understand real estate development. But he saw people getting rich flipping houses, saw condo towers going up, saw developers making millions. He thought, this is easy. I should do this. He formed a partnership with a local developer, put in $500,000, bought land for a residential development in Las Vegas. Did he understand zoning laws? No. Did he understand construction costs? No. Did he understand financing structures? No. Did he understand real estate cycles? No. But he saw other people making money, and he wanted in. The development took longer than expected. Costs overran the budget by 40%. Then came 2008. The housing market collapsed. The land became worthless overnight. The debt came due. He lost the entire $500,000. 5 years of after-tax savings gone. He was smart. He just invested outside his circle of competence. He understood human anatomy. He didn't understand real estate development. The difference destroyed him. Let me show you something that will make this crystal clear. Pull out your portfolio right now. I'm serious. Open your brokerage account. Look at your biggest position. Now ask yourself 3 questions. 1. Could I explain this business to a 12-year-old? 2. Could I predict its revenue in 5 years within 20% accuracy? 3. Do I understand what could kill this business? If you answered no to any of those, you need to reconsider that position. You don't understand what you own, and you can't make rational decisions about things you don't understand. Here's the arithmetic. If you invest in 10 businesses and genuinely understand 2 of them, your odds are terrible. The 8 you don't understand will produce unpredictable results. Some will work. Most won't. You're gambling. If you invest in 10 businesses and genuinely understand all 10 of them, your odds are much better. You can predict outcomes. You can see threats. You can act rationally. You're investing. Same number of investments. Different understanding. One approach is gambling. The other is investing. Warren always says, never invest in a business you cannot understand. People think he means the business model must be simple. That's not what he means. He means you personally must understand it well enough to predict its economics 5 years out. I can understand railroads. I cannot understand biotechnology. That's not because railroads are simple and biotech is complex. It's because I spent time understanding railroads and I haven't spent time understanding biotech. The complexity is irrelevant. The understanding is everything. Most investors never define their circle of competence. They just buy whatever sounds good. They read analyst reports, listen to CNBC, follow trends. They have opinions on hundreds of companies, and they genuinely understand maybe 3. The successful investors I know understand maybe 20 to 30 businesses deeply, and they wait for those specific businesses to become attractively priced. They don't invest in 200 things they barely understand. They invest in 20 things they know cold. The boundary of your circle is not a limitation. It's a tool. It tells you what to ignore. And in investing, knowing what to ignore is more valuable than knowing what to buy. Know your circle of competence. But staying inside it requires a different way of thinking about the future. Now here's where it gets dangerous, because even if you invert correctly and stay in your circle, you can still destroy yourself if you make the next mistake. And this mistake is subtle. Most people don't even realize they're making it. Most people want certainty. They want to know the stock will go up. They want guarantees. They want to be right. And this desire for certainty destroys their ability to think clearly about risk. Here's the truth. There are no certainties in investing. There are only probabilities. Every investment has a range of possible outcomes. The successful investor thinks in terms of those ranges. The unsuccessful investor thinks in terms of one outcome, the one they want to happen. This isn't about predicting the future. It's about understanding the distribution of possible futures and positioning yourself to survive all of them and profit from most. Let me show you what I mean. Warren and I bought See's Candies in 1972 for $25 million. People thought we overpaid. See's earned $4 million that year. We paid over 6 times earnings for a mature candy company in a competitive market. Expensive by any measure. But we didn't think, this will definitely be worth X in 10 years. We thought probabilistically. We asked, what are the possible outcomes? What could go right? What could go wrong? How do we protect against the bad outcomes while capturing the good ones? The best case. See's was a beloved brand in California. If they could expand regionally and raise prices steadily without losing customers, they could generate massive cash flow for decades. Maybe $50 million or more annually within 20 years. The base case. See's maintained its market position in California. Earnings grew with inflation, maybe $10 million to $15 million annually within 20 years. We'd get our money back plus a decent return. The worst case. The brand faded, tastes changed, competition intensified, earnings declined. We could lose half our investment, maybe the whole thing. We weighted those probabilities. Best case, 20%. Base case, 60%. Worst case, 20%. The expected value was positive, even accounting for the downside scenario. And the downside was survivable. We wouldn't be destroyed if we were wrong. That's probabilistic thinking, not this will happen. But here's the range of what might happen, and here's how we protect ourselves. By 2025, Seas generates over $70 million in annual profit on that same $25 million investment. Over 50 years, it's produced more than $2 billion in cumulative profit. But that was never guaranteed. It was just the outcome that happened to occur within the range we considered possible. Most investors don't think this way. They fall in love with a story. They convince themselves of one outcome. They ignore the alternatives. And when reality diverges from their story, they're shocked. They panic. They sell at the worst possible time. I watched this with Tesla investors in the 2010s. People bought the stock and told themselves one story. Electric vehicles will dominate. Tesla will be the winner. The stock will go up. They assigned 100% probability to that outcome. But there were other possible outcomes. Established automakers could catch up. Batteries could fail to improve fast enough. Elon Musk could get distracted or make catastrophic mistakes. Regulations could change. Competition could intensify. Manufacturing could break down. Demand could disappoint. The company could go bankrupt. Some Tesla investors made fortunes. Good for them. But many others lost money because they never thought probabilistically. They thought in certainties that didn't exist. When the stock dropped 60% in 2022, they panicked and sold. They couldn't handle normal variance because they convinced themselves the gain was certain. Here's what nobody tells you about probabilistic thinking. It feels wrong. Your brain hates uncertainty. It wants certainty. It wants to believe the stock will go up. It wants to eliminate doubt. But the investors who get rich, they're comfortable saying, I don't know. In fact, the more often you can say, I don't know, the richer you'll become. Because I don't know keeps you out of investments that destroy you. Here's the arithmetic. Say you have a 70% chance of making 50% on an investment and a 30% chance of losing 30%. The expected value is 26%. Positive. That's a good bet. But 1/3 of the time, you lose money. If you think the gain is certain, that loss will feel like betrayal. You'll panic. You'll abandon the strategy. You'll sell at the bottom. If you think probabilistically, that loss is just the distribution playing out. You expected it. You sized your position appropriately. You move on to the next opportunity. Over 10 investments with those odds, you might lose on 3 and win on 7. You end up significantly ahead. But you must be able to stomach the 3 losses without panicking or abandoning the strategy. Most people can't. They think probabilistically until they lose. Then they think in certainties. This strategy doesn't work. I was wrong. I need a new approach. And they abandon a profitable strategy because of normal variance. Warren lost money on Dexter Shoe Company. He paid $434 million in Berkshire stock for a business that went to zero. Total loss. Does that mean his thinking was wrong? No. It means one outcome from the probability distribution occurred. He's made hundreds of investments. Most worked, some didn't. That's how probabilities play out. The difference between Warren and most investors is that he thinks probabilistically before he invests, sizes positions appropriately for the risk, and doesn't panic when the unfavorable outcome occurs. Think in probabilities, not certainties. But even perfect probabilistic thinking fails without the next principle. The most important concept in investing is margin of safety. This is what Benjamin Graham taught Warren, and it's what Warren taught me. Every investment decision should include a buffer between what you pay and what something is worth. That buffer is your margin of safety, and it's what keeps you alive when you're wrong. Here's why this matters. Your valuation will be wrong. Your assumptions will be wrong. The future will unfold differently than you expect. That's guaranteed. The question is, can you survive being wrong? If you buy a business worth $100 for $98, you have a 2% margin of safety. One small mistake in your analysis, and you lose money. If you buy that same business for $50, you have a 50% margin of safety. You can be wrong about half the value and still break even. You can be right about only a portion of the value and still make money. Most investors do the opposite. They fall in love with a business, convince themselves it's wonderful, and pay full price or more. They have no margin of safety. They need everything to go right. And when it doesn't, and it never does, they lose money. Let me tell you about a young investor I knew in the 1960s. He was 28 years old, smart, ambitious, found a small manufacturing company in Ohio. Good business, solid management, growing earnings. He ran the numbers. He calculated it was worth $20 per share. The stock traded at $19. He thought, close enough, good business, I'll buy. He bought 10,000 shares at $19, invested $190,000. Everything he'd saved. He was right about the business, it was solid, but he was slightly wrong about the timing. The economy slowed. Earnings dipped 20% that year. The stock fell to $12. He panicked and sold, lost $70,000 in 6 months. He wasn't wrong about the business. He was wrong about the price. He paid $19 for something worth $20. No margin of safety. One hiccup, and he was underwater. The psychology of being down 37% broke him. Now consider a different approach. Same business, same $20 valuation, but instead of buying at $19, he waits. He's patient. The market panics about something unrelated, maybe a recession scare, maybe inflation worries. The stock drops to $10. Now he buys. Same business, same analysis, but now he has a 50% margin of safety. Earnings can drop 40%, and he still makes money. The economy slows. Earnings dip 20%. The stock falls to $12, but he's still up 20% from his purchase price. The psychology is completely different. He's calm. He holds. 2 years later, earnings recover. The stock goes to $25. He more than doubles his money. Same business, same investor, same analysis. Different margin of safety. One approach leads to losses and panic. The other leads to profits and confidence. Let me be blunt. Right now, some of you are sitting on investments that have no margin of safety. You bought at full price. You need everything to go perfect, and you're one recession away from losing 20 years of savings. I'm not trying to scare you. I'm trying to wake you up. Because if you don't build margin of safety before the next crash, you won't get a second chance. Here's the arithmetic. If you pay $1.0 for something worth $1.0, you need to be exactly right. If you pay $0.50 for something worth $1, you can be 50% wrong and still break even. The margin of safety is the difference between requiring perfection and tolerating error. Warren has never bought a business at full price. Never. He waits for the margin of safety. Sometimes he waits years. Sometimes he waits decades. In 2008 and 2009, when everyone was panicking, he bought aggressively. Why? Because prices had collapsed and margins of safety were enormous. He could be wrong about a lot and still make money. Most investors can't do this because waiting feels like doing nothing, and doing nothing feels like failure. They want action. They want to deploy capital. They want to feel smart. So they pay full price and they eliminate their margin of safety. I've made mistakes in my life, many of them, but the mistakes that never destroyed me were the ones where I had a margin of safety. I was wrong, but the buffer protected me. The mistakes that hurt the most were when I had no buffer. I needed to be right, and I wasn't. The margin of safety isn't just about valuation, it's about every assumption you make. You assume a business will grow at 10% annually. Build in a margin of safety. What if it only grows at 5%? Do you still make money? You assume the market multiple will stay at 15x earnings. What if it contracts to 10x? Do you still make money? You assume management will execute flawlessly. What if they don't? Do you still make money? If the answer to any of these questions is no, you don't have a margin of safety. You have a bet that requires perfection, and perfection never comes. Build a margin of safety. But even with perfect safety buffers, you'll fail without the final discipline. Now, I'm going to tell you the one mistake that destroys everything. The mistake that cost Rick Guerin billions. The mistake that most of you are making right now. And the discipline that separates investors who build generational wealth from the ones who stay poor forever. The market is not rational. It never has been. It never will be. The market is emotional, manic, depressive, euphoric, and terrified, often within the same week. And if you let the market's emotions dictate your decisions, you will buy high, sell low, and stay poor. Here's the truth. The stock market is a voting machine in the short run and a weighing machine in the long run. In the short run, prices reflect emotion, fear, greed, excitement, panic. In the long run, prices reflect value, earnings, cash flow, economic reality. The successful investor ignores the short run and focuses on the long run. The unsuccessful investor does the opposite. Most people can't do this. They check their portfolio daily. They watch CNBC. They read headlines. They feel pain when stocks drop and euphoria when stocks rise. And these emotions corrupt their judgment. This is what destroyed Rick. Let me tell you the full story now. Rick was Warren's and my partner in the 1960s and 70s. Brilliant man. We invested together. We thought similarly. We made very similar investment decisions. But Rick had one weakness he couldn't control. He couldn't ignore the market's emotions. When stocks went up, Rick felt smart. He felt validated. He felt powerful. He wanted more, so he used margin to amplify his bets. Not crazy amounts, 2-to-1, sometimes 3-to-1. It seemed reasonable at the time. When stocks went down, Rick felt stupid. He felt stressed. He felt the pressure mounting. The margin magnified not just his returns, but his emotions. Every down day felt catastrophic. And in 1973 to 1974, when the market crashed 50%, Rick couldn't ignore the emotion anymore. The fear, the margin calls, the pressure from his lenders. They forced him to act. And he had to sell his Berkshire shares at $40 per share just to meet the margin calls. Warren and I experienced the exact same market crash. Our portfolios dropped just as much, but we had no margin, no debt, no one forcing us to sell. So we didn't check prices daily. We didn't watch the tape. We didn't care that the market was down 50%. We knew Berkshire was a good business. We knew it would be worth more in 10 years regardless of what it traded for today. The market's opinion was irrelevant. So we held. We even bought more when we could. Rick's emotions, amplified by leverage, forced him to act. Our indifference allowed us to sit still. That difference Emotional reaction versus rational indifference is why Warren and I are billionaires, and Rick is not. Those Berkshire shares Rick sold at $40. Today, they're worth over $700,000 each. If he'd held just $10,000 back shares, which he easily had, that would be $7 billion today. $7 billion lost because he couldn't ignore the market's emotions. Let me tell you something. The market will try to make you feel something every day. When prices rise, it will make you feel smart and greedy. Buy more. You're winning. Don't miss out. When prices fall, it will make you feel stupid and afraid. Sell before it gets worse. You're losing everything. These emotions are designed to make you act, and almost every action destroys wealth. The market doesn't care about you. It doesn't care about your retirement. It doesn't care about your goals. It's just millions of people making emotional decisions based on fear and greed. And if you let their emotions become your emotions, you'll end up like Rick. Here's the arithmetic that proves this. If you bought the S&P 500 in January 2000 and held through December 2024, you made about 8% annually, including dividends. Not spectacular, but solid. That 8% turned $100,000 into $520,000. But that period included two crashes: the dot-com bust, 2000-2002, down 49%, and the financial crisis, 2007-2009, down 57%. If you let the market's emotions dictate your actions, if you sold during either crash out of fear, you locked in catastrophic losses and likely never recovered. Your returns would be far worse than 8%, probably negative. Your $100,000 might be worth $60,000 today. But if you ignored the market's emotions, if you held through both crashes or bought more during the panic, you made 8% annually. Your $100,000 became $520,000, same period, same market, different emotional discipline. One investor has $520,000, the other has $60,000. Most investors can't do this. In 2008 and 2009, when the market was down 50%, investors pulled $200 billion out of stock funds. They sold at the bottom. Then, in 2020 and 2021, when the market had recovered and hit new highs, they piled $500 billion back in. They bought at the top. This is the opposite of investing. It's pure emotional reaction, and it destroys wealth systematically and predictably. Warren has a saying, "Be fearful when others are greedy, and greedy when others are fearful." That's not a clever aphorism. It's a description of emotional discipline. When the market is euphoric and prices are high, ignore the euphoria and be cautious. When the market is terrified and prices are low, ignore the terror and be aggressive. I've sat through a dozen market crashes over my 99 years. 1973, 1994, 1987, 2000, 2002, 2008, 2009, 2020. Each time, the headlines screamed panic. This time is different. The system is collapsing. Get out now. Each time, people sold. Each time, the market recovered. And each time, the people who ignored the emotion got rich, while the people who reacted stayed poor. The market's emotions are not information. They are noise. Price movements don't tell you about business quality. They tell you about human psychology. And human psychology is predictably irrational. Ignore the market's emotions. That's how you survive long enough to let compounding work. I learned to think this way from two people. The first was my grandfather, Ingham. He came to Iowa with nothing, fought in wars, survived the Depression, bought cheap land during panics when everyone else was terrified. He bought a few farms, leased them to thrifty Germans who paid reliably. He never speculated, never rushed, just bought what was cheap and waited. He told one story over and over to us grandchildren. He said, "In a life like mine, when you were located in the right place, you got a few opportunities if you lived to be about 90. And the trick to coming out well was seizing the few opportunities that were your share when they came along. A few opportunities, not a million, a few. He waited for them, and when they came, during panics, when land was cheap and everyone was scared, he acted. That's how he became the richest man in town. Not by being brilliant, by thinking clearly when others were emotional. The second person was Warren Buffett. I met Warren in my 30s. We thought the same way. We both inverted. We both stayed in our circle. We both thought probabilistically. We both demanded margin of safety. We both ignored the market's emotions. For 60 years, we built Berkshire using these same 5 principles. We never deviated. We never got clever. We never chased fads. We never tried to time the market. We just thought correctly and waited. And compounding did the rest. Let me make this simple. Here are the rules. 1. Invert. Always invert. Ask how to lose before you ask how to win. That is survival. 2. Know your circle of competence. Invest only in what you genuinely understand. That is wisdom. 3. Think in probabilities, not certainties. There are no guarantees positioned for the range. That is realism. 4. Build a margin of safety. I'll pay 50 cents for a dollar. That is protection. 5. Ignore the market's emotions. Price movements are noise. Business reality is signal. That is discipline. These are not complicated rules, but almost nobody follows them because they're not easy. They require patience. They require intellectual honesty. They require you to sit still when everyone else is acting, and modern investors hate sitting still. Here's your challenge. Before your next investment, write down the answers to these questions. What am I missing? What do I not understand about this business? What are the 5 ways this investment goes wrong? What is my margin of safety? Why am I buying this now instead of waiting for a better price? If you can't answer those questions with confidence, you're not investing, you're gambling. And here's the truth that nobody wants to hear. Most of you will ignore this advice. You'll keep checking your portfolio daily. You'll keep reacting to price movements. You'll keep buying things you don't understand. And 20 years from now, you'll wonder why. You're not wealthy. Don't be that person. I'm 99 years old. And the reason I'm telling you this now, really burning it into your brain, is because I've watched too many smart people lose everything. Rick Guerin was one of the smartest people I ever met. Top of his class at USC, built a successful investment partnership, made the same investments as Warren Buffett. But one mistake, using leverage because he couldn't wait, cost him billions. He should be on the Forbes 400 list. Instead, he's a cautionary tale that Warren and I tell to remind ourselves what happens when you let the market's emotions dictate your decisions. Don't be Rick. The formula is right in front of you. Invert. Always invert. Stay in your circle. Think probabilistically. Build margin of safety. Ignore the noise. That's it. 5 rules. Follow them for 40 years and you'll die rich. Ignore them and you'll spend your retirement wondering where it all went wrong. Do not wait. Do not make excuses. Start thinking correctly today, because every day you delay is a day of compounding you lose forever. The difference between building generational wealth and dying broke isn't intelligence. It isn't luck. It isn't market timing. It's thinking correctly about 5 simple principles that most people violate every single day. You now know what Rick didn't. You now know what destroyed the Nobel Prize winners at long-term capital management. You now know what separates Warren and me from every investor who panicked and sold during crashes. The question is, what will you do with this knowledge? Now, if you want more brutal honesty about investing, timeless principles that actually work instead of get-rich-quick garbage, subscribe to this channel. We don't promise easy. We don't promise fast. We promise truth. And if you made it this far, drop a comment telling me which of these 5 rules you violated. Be honest. Because you can't fix what you won't admit. The clock is ticking. Your next decision will either compound your wealth or destroy it. Choose wisely.